Hello, this is Ji-Hoon Mi from the University of American Studies. As always, today I have brought Ji-Hoon Mi's second master. Chief Executive Officer In-Jung Kim is here. Hello.
Hello, Chief Executive Officer. Nice to meet you.
Now that you're officially part of the Mi-Ji-Hoon family and appear regularly like this, I actually rely on you a lot. The other day I took a break from broadcasting, but Chief Executive Officer Kim In-jung uploaded 2 videos as if we had planned it. So I can't tell you how much lighter I felt while resting. Thank you. I give my thanks again.
Yes, thank you for letting me be part of the family.
Today is the day of the American Stock Elementary School broadcast. As time goes on, there are more and more comments and more people leaving questions. From what I see compared to the beginning, there are a lot more people studying actively and passionately. Last week we took a close look at PEG ratio and there were a lot of questions. Since you said you would answer the important questions first, I think it would be good to start with a review before moving on.
Yes, we covered PEG last week. Because when it comes to United States stocks, they're either dividend stocks or growth stocks, and it seems like most investors are growth stock investors. In fact, for growth stocks, the PR is often as low as 50 to 70 times, and sometimes even goes over 100 or 200 times. Since there are so many areas where it's really hard to evaluate, it feels like people are just investing based on trends without any real valuation methods. As an alternative, PEG is becoming very popular in the market right now. It's not used much in Korea, but in the United States, it seems like a lot of investors are using PEG. But I wanted to point out that there are some pitfalls if you use those things incorrectly. So I explained various things last week. I feel like I might have caused some doubts for people who had faith in PEG. There were some people who seemed quite confused. I'll try to supplement that part a bit more and explain it first, then continue with the rest of the explanation. Okay, first you can see the screen, right?
Yes, I can see it well, yes.
A question like this came up. I think the reason for using PEG is to judge how reasonable the current value, that is the PER, is based on future growth rates, since it's about determining whether the current PER is reasonable. I think it makes sense to use the current pair as the numerator, but I don't really understand why people use the forward pair. So I'm not interested in whether the future PER is reasonable right now. I'm wondering if I'm using this incorrectly or if there's another way to look at PEG. So it seems like the PEG you were using well before has suddenly become confusing, so I think I need to help organize PEG for you again. Let me explain it to you. First of all, that's a good question, thank you. Basically, PEG is, as you mentioned, it's correct to use the current trailing 12 months PER. We use the current PER. Next, you need to pay close attention to the denominator. Originally, PEG is calculated using the average annual growth rate over the next 5 to 7 years for the denominator. That's the normal way to calculate PEG. But if you look at websites and places like that, most of them find it difficult to predict the average annual growth rate for the next 5 to 7 years. In most cases, they just use next year's earnings per share growth rate to calculate it. At this point, we are already deviating from the original principle of calculating PEG. So instead of using 1 year's growth rate as the denominator, we should use a longer term rate since earnings per share growth can vary greatly each year. Unless the company is very stable, growth rates can fluctuate greatly. 1 year over 100%, then 50%, then 40%. Because of that fluctuation, the PEG values can change drastically. So then the PEG value, for example, this year's growth rate was only 0.2, but when combined with next year's rate, the PEG jumps above 1. Is this currently undervalued or overvalued? How should we assess it? You need to look at next year's growth rate and the year after that as well. Since we keep looking at the growth rate for the year after next, the PDR shouldn't stay stuck on past figures. So it's better to adjust it and look at both together to supplement each other. That's what I meant. Basically, the person who asked the question, your opinion is correct and what you know is right. So it's right to use the current PDR, but for the denominator below, it's correct to use the expected future growth rate. So as an example, last time I explained this using the case of Yamdeal. This PEG value, for example, when we say 1.97, we're using next year's growth rate for the calculation. I did that, but now I also went on Seeking Alpha and searched for the PEG value. On Seeking Alpha, PEG values are given for trailing 12 months generally accepted accounting principles and generally accepted accounting principles standards, but they usually use the generally accepted accounting principles standard. Depending on the PEG value calculated by Seeking Alpha. In this formula shown here for Badel-Minjock, PER currently uses the sum of the last 4 quarters, trailing 12 months, and as for the earnings per share growth rate, it's also using the sum of the most recent 4 quarters. It uses the year-over-year growth rate. So I think Seeking Alpha's PEG is a bit off from the essence of what PEG really is. That's because the PEG value itself is meant to show whether the current par is too expensive or too cheap. The basic concept is that since it's hard to evaluate this kind of growth rate, let's take future growth rates into account. But the growth rate based on the sum of the last 4 quarters is already a past growth rate. Since it's a growth rate that's already been determined, I think using PER based on expected growth rate is closest to the true PEG value. The PEG value will likely vary across sites. Yahoo Finance, Seeking Alpha, and ours will each report different numbers. So it's really important to look at what the standard is, whether the reference year is talking about the current PEG or if it's using the expected growth rate for the next year to calculate the current PEG. Taking all of that into account and making a comprehensive judgment was the most important message from last week's session. I searched for a few more companies. Among those who asked questions on Seeking Alpha, many of you asked about Micron technology. You asked the PG ratio is really low, so why does our site show Micron as overvalued? We don't use the PEG ratio for our valuation. We sometimes calculate using PER considering the growth rate, or use price to sales ratio, economic value added, or even VITA. First, I searched for Micron technology on Seeking Alpha and the PEG ratio comes out to 0.03. Now 0.3 is already considered very undervalued, but 0.03 means it's extremely undervalued. So this 0.03% comes from the sum of the last 4 quarters per that I mentioned earlier. It's because we use the earnings per share growth rate summed over the most recent 4 quarters. But if we change it to the expected future growth rate, this PEG value should also change. Generally, we say that if the PEG is around 1, it's considered fairly valued. For Micron technology, what does the formula look like if you calculate 0.03? The stock price must rise 33-fold to reach fair value. That's the conclusion. So right now, Micron technology, if the stock price increases 33 times, it reaches about $7,458. Does this mean Micron technology's fair value is $7,400 now? That's what my question is. So you shouldn't just look at the PEG ratio at face value and think that if it's 1 or 2 in the morning, it's cheap. You have to make sure to check when the standard was set and things like that. So with PEG, it's in the denominator. You need to use the expected future growth rate so you can accurately determine whether something is expensive or cheap based on the actual growth rate. I think it would be good if you could remember this part first. At least Micron Technology is a company with an August fiscal year. Since their fiscal year ends in August, the PEG value on our side for Micron Technology doesn't appear very high right now. Since it's only October, there's still growth left until next August. But now, take a look at companies with a December fiscal year. Even if we use the expected earnings per share growth rate for December fiscal year companies, let's say we use the expected growth rate as of the end of this December. If you compare earnings per share growth at the end of 2025 to last year and divide the current PER by that, it's still an expected growth rate. It's an expected growth rate, but when you calculate the PEG now, you use the growth rate as of December 2025. But now, the end of October has already passed. By the time you watch this, it'll be November. Now, after 2 months pass, for example, this is what happens. Let's say there's a company whose earnings per share growth rate was 50% in 2025 and 25% in 2016. Then even if the PDR doesn't change at all and the stock price doesn't move, as soon as it becomes January 1, 2026, the growth rate drops to 25%, so the PEG doubles. Now let's say there was a company with a PEG of 0.6 until the end of December. It was 0.6, but when January came, it became 1.2. So is this company currently undervalued or overvalued? What I wanted to ask is this. That's what I wanted to say, but it may be hard to cover this early in the show. I think there were a lot of different questions. But instead of simply understanding PEG as 0 or 5, you have to consider those aspects together as well. We used the future PDR and calculated it using the future earnings per share growth rate. I mentioned that it's a bit more reasonable to compare the PEG for the next year and the year after that, and I think it would be good if you could understand it that way.
Today I spoke passionately again.
While explaining in detail.
Thank you for giving such a detailed explanation. Since Seeking Alpha was mentioned, I'll give a brief explanation. Seeking Alpha provides two PEG ratios. One is trailing 12 months and the other is forward. The calculation method for forward is a bit different. So as Chief Executive Officer Kim Young-jin mentioned earlier, when Peter Lynch originally introduced the PEG ratio factored in the projected 5 to 7 year growth rate. Since analysts these days don't even make projections that far out, Seeking Alpha has shortened it to 3 to 5 years on their own. So it would be good to keep in mind that the forward PR is made by taking into account not just the expected growth rate for 1 year, but also how much the company is expected to grow over the next 3 to 5 years. And in my case as well. Actually, I don't really use trailing 12 months, and I look at forward a lot, especially when looking at PEG. Especially the growth stocks that investors have been paying a lot of attention to lately. I think they're planning far beyond just 1 year ahead when investing. So looking at trailing 12 months is already fully reflected in the stock price, and it's used just to get even a small hint about the future direction of the stock price. Then I also look at PEG. I think it's more reasonable to look at the forward. I just shared my personal opinion. All right, then let's wrap up the review here. What kind of things will we...
The part you just mentioned, Chief Executive Officer, this is exactly what I'm talking about. In our case, since the end of December 2025 has already passed, in fact, in the investment market, we've already moved on to the next year. We're already reflecting this growth rate, so if you calculate the current PR based on 69, it's 19 right now, well, 19.7. But if you look at next year, the forward PR becomes 59 times. That's right. If you divide by this, it means it's 0.85, as we discussed last time. So, even though it's 1.97 now, it could drop to as low as 0.85. Looking at AMD and saying that AMD's current PEG is 2 times are a bit different concepts, so it would be good to supplement your view with this distinction.
I have a request. Then, can we also add a forward next to PEG, also in the choice tag?
Forward next to PEG later. Yes.
So for that, since the expected growth rate is already shown and the forward PR is also displayed, we just need to add the calculation formula.
Yeah, that's true. So now for us, the date standard, whether we should change the standard exactly on December 31st or at another time, will probably depend on the forward. First, we'll set a policy and then add it at an appropriate time.
Yes, please take care of it. Yes, we reviewed the PEG ratio we learned last week in more detail. What great lecture do we have prepared for this week?
Saying it's a great lecture puts pressure on me. We started lightly with the basics of United States stocks, but it's been going on for quite a while now, and there are quite a few people watching from the very beginning. I think they've probably seen our previous event videos as well. We often get questions on Channel Talk like, I heard that annual members get the United States Stock Basics PDF file. We send it to everyone. So I guess there are people who are starting to study from the beginning again, and that makes me feel really proud. Yes, it's difficult. It's not a famous lecture, so I'll just try to explain things as simply as possible and share what I understand. Today, I'm going to explain Benjamin Graham's formula for growth stocks. Actually, when you think of Benjamin Graham, you might think of the cigar butt stocks he bought only when their market cap was below their net current assets. Most know him as an investor, but he also spent much time on growth stocks. So if you look at books like The Intelligent Investor or Security Analysis, you'll see that they cover a lot of those topics. He established the systematic and theoretical foundation for security analysis. I think we should consider him the first wise man in this field. Within that framework, Warren Buffett, Charlie Munger, Templeton, and Professor Damodaran all emerged. I think this is how the field keeps growing. I'd like to introduce some of the stories that were in that book. Graham also thought a lot about growth stocks. It would be great if masters like Graham could organize those formulas for us, but none of the masters have ever actually stated the fair stock price they're calculating as a number. Even Warren Buffett says he calculates intrinsic value by discounting future cash flows at an appropriate discount rate, but when asked what that discount rate is or how many times he uses, he doesn't give a specific answer. Then he just answers in a text-based way, saying things like considering the risk-free rate and inflation. Since they don't give exact numbers, it's not easy to know the valuation formulas of the great investors precisely, but it's nice that Graham clearly wrote them out with numbers. So let's take a look at what kind of thoughts they have. Fair stock price is usually calculated as earnings per share times the appropriate PRR, reflecting how many times the PRR should apply to this company. This is actually the core of valuation, but I'll explain this part in detail next time when I cover valuation throughout the series. So, since we're multiplying by PR, we're ultimately multiplying by a multiple, and it's the same here. Graham also said that you multiply earnings per share by a multiple, and for growth stocks, he decided to use this as the multiple. 8.5 plus 2G, where G stands for growth rate. The growth rate at which this company can grow over the next 7 to 10 years, it's kind of similar to a perpetual growth rate. What Seeking Alpha talks about is that you can also use the 3 to 5 year growth rate as a substitute. So what this means is that you double this growth rate, that's what 2G means, 2 times G. So it means we've given a significant premium to growth stocks. So if you look at it just by this formula, he's even more aggressive than Peter Lynch. That's right. Peter Lynch's idea was to give a PER equal to the growth rate. So in the formula earnings per share times PER, he thought the PER should only match the growth rate. But Graham's like, well, what are you talking about? You should give it double. That's right. So my perspective on Graham completely changes. Did people who thought of this person as a value investor see him this way? He gave such a bold valuation to growth stocks that it seems more fitting for evaluating today's growth stocks. It was quite unconventional. Instead of the 1 year growth rate, since growth rates fluctuate up and down, this isn't that rate. It's the same for PEG calculation. At the very least, after this company has made a lot of money, let's use a sustainable level of earnings per share growth rate. Buffett called this the sustainable return on equity. He said we should use that return on equity or that growth rate, whatever percentage it is. This is something that can only be estimated. It's pretty amazing to say, let's add a multiple of 2 or even give it 8 or 5 times more. Then let me try putting 0% growth rate here. So the question becomes, how many times should we give to a company whose earnings per share doesn't grow? Then the explanation is that we give it 8 or 5 times. Then, for example, there are companies that earn the same earnings per share every year, like $3, $3, $3, $3, $3.01, $3.05, and so on. So, how should we assign the PEG for these companies? With no growth, valuing it is actually difficult. People keep saying 8.5 times. That's what they say, 8.5 times. This 8.5 times is... This is 8.5. I don't know if you remember, but the inverse of PER is the rate of return. I've explained this before. If you forgot our talk about PER, look it up. I said 1 over PER equals the rate of return. So 1 over 8.5 is 11.7%. So what I'm saying is, Graham is saying that for a company whose earnings are not growing, the expected rate of return should be about 11.7%. Of course, it should be higher than bonds, so he said you should give about 8.5 times.
That means if you invest for 8.5 years, you break even, right?
Yes, that's right. Anyway, since the PER is 8.5, if you assume the amount stays the same for 8.5 years, you break even. But since the company grows, the concept of growth isn't included in the PER because it's just a unit concept. If it grows by 20% each year, the payback period becomes much shorter, so you have to give a higher multiple. In the original book, it stops at earnings per share times 8.5 plus 2G. I believe that's as far as the intelligent investor goes. But if you look at other works by Graham or in some papers, you'll see that this part was added later on. What this is that 4.4 divided by y is added in. Yes, sir. It's a discount, so it has the effect of lowering the amount. If it's not 4.4 but 2.2 yes, then it becomes double. So it means let's give double the amount we calculated earlier. It's a surcharge factor, so the indicator at the end uses this number as the discount or surcharge rate. So then what exactly is actually, there's not much that's clearly revealed about this. So after putting together various theories and stories, and based on things discussed here and there, or written in papers or articles at the time of Graham, in 1962 the yield on AAA corporate bonds. Now, the reason we look at corporate bond yields is because stocks are supposed to have a higher yield than this. That's why. So when comparing bond interest rates, specifically corporate bond interest rates, the yield should exceed that of long-term corporate bonds. So in 1962, they set and fixed it at 4%. And what this Y means is currently, by dividing the yield of a 20-year or 30-year corporate bond. So if the interest rate is lower than 4%, raise it. And if the interest rate is higher than 4%, lower it. I'm coming up with an amazing formula. Why did I come up with such an amazing formula? It's not that this formula is 100% correct. When you study valuation, this concept is crucial. When valuing a company, you'll encounter questions like whether to use earnings per share, cash per share, or free cash flow as the basis. Company value consists of three factors: company value times an appropriate multiple, then adjusted by a discount or premium. So, when we calculate the fair stock price in the future, if we assign a multiple to a company, and for some companies, as you can see, some companies are seen as cheap with a PER of 50, while others seem expensive at 10. Why are these multiples assigned so arbitrarily? This is one of the questions that doesn't get answered easily when you first study valuation. They say this company deserves a multiple of 15, so they've calculated its fair stock price. But in the same industry, for another company, they say it should be multiplied by 11, making over a 30% difference. So can I calculate the fair stock price any way I want based on the multiple I choose? That's why people sometimes doubt fair stock price calculations, but there are reasonable ways to determine discount or premium rates. Estimates must be made individually, but we can discuss those parts later. When we do the valuation, I'll explain each step one by one from the very basics. This formula is company value times the PER multiple, reflecting growth rate with an interest rate-based discount or premium. That's the summary for now. Now, let's take a look at some actual data. This is actual data from a United States stock, N company. The current price is $186.26 and the PAR is 52.3 times. Also, there's a company with an earnings per share of $3.52. So we have these two things right now. This is actually already confirmed. Currently, what we need to find now is this. We have to find it. Since we need to use the future earnings per share growth rate, we can put it into this formula. Then, for example, I'll explain a bit more later while looking at actual company data, but let's say this company can grow by about 25% for around 5 years, assuming it's a company that grows at that annual average rate. I've tried putting the numbers in here. 3.52 times 8.5 times 2, and here, since it's 25%, it's not 0.25. Just remove the percent sign and use 25. As I said, when calculating PEG, we drop the percent sign from earnings per share growth and use just the number. The same applies here. So you just use 25 multiplied by 44 divided by 5 and 21. I just found this now and I'll show you where to find it too. So after calculating like this, it's like, let's give this company a PER of 58 times. That's pretty amazing. But since the interest rate is 4 higher than 4, let's discount it a bit. I'll cut 16% from the amount. That's what they're saying. And then they say that about $173 is appropriate. That's what they're talking about right now. Yes, then now, yes, I'll explain up to here, and then I'll move on to look at the actual data of this company. I mentioned 25%. Some people ask me about this. When we talk about the fair stock price, it's always... You have to specify whether it's the fair stock price at the current point, a year later, or 2 years later. You shouldn't talk about the fair stock price without mentioning the reference year. So sometimes when I say the fair stock price is $380, I mention that it's based on the year 2026. A fair stock price without a reference year doesn't make sense. In this case, I worked with the projections for 2025. If this company grows steadily by 25% each year for the next 5 years, how will the fair stock price change? Then you might think we need to multiply the earnings per share by all those growth rates. But actually, if you keep multiplying the fair stock price by 25% each year, you end up with the same value. No need to add earnings per share again or redo those calculations. It's simply that the stock price rises by the growth rate, so that's all you need to consider. You just need to multiply this. Based on 2026, the fair stock price is $217, rising to $270 the next year, and so on. So earlier, I wrote down the current price for you. It's $186. The current price is $186. It's $186. But the end of 2025 hasn't come yet. Right now, it's the end of October 2025, or actually, it's November. Now, when we look at our data, is this overvalued or undervalued? Since it's higher than 173, you could say it's slightly above the fair value. All right, now let's take a look at 2026. So there's about a year and 2 months left. Is it undervalued or overvalued compared to $217? In this case, it seems undervalued. All right, then let's move on to the next year. In 2027, the fair stock price is $271. So if it's $186 now, it's just fairly valued. So what I want to say is that depending on the base year, the current stock price can look overvalued or undervalued depending on what you consider the fair price to be. Then, if you guys are planning to invest until 2017, if you subtract $186 from $271, that's about $85 of potential upside. So if you divide $85 by $186, that means there's about 45% potential upside. Since it's 2027, counting from 2026 is 7 years plus 2 more, including 2027. If there's a stock that gives about a 45% return over 2 years, would you invest in it? That's what I asked. So how would you answer? If you expect a higher return than this, you shouldn't buy at this price. You need to buy it at a lower price. To me, 45% in 2 years is great, over 20% per year on average. So you could buy it even at $186. That's my point, it doesn't matter. So it's really important to time things well. So now let's move to the site and...
There's just one thing I'd like to add. Sometimes regarding long-term investors, many people... Now you express your own opinion. But if I may briefly share my opinion, I don't think a long-term investor is someone who never sells a stock once they buy it. However, many people challenge that, saying, if you keep buying and selling stocks, how is that long-term investing? But could you bring up the chart you just showed again for a moment, the PowerPoint? What I consider long-term investing is this. In the end, whether it's 2026, 2027, or 2028, I think long-term investing is about looking at how much potential there is in the future compared to the current stock price. So this is how I approach long-term investing. One more thing I pursue here is momentum, which people talk about a lot. But if you only focus on momentum in terms of stock prices going up and down, honestly, emphasizing momentum doesn't seem very meaningful or important. But the momentum I'm talking about, I think it shows changes in fundamentals. What I mean is, the reason we can keep predicting fair stock prices for 2025, 2026, 2027, and 2028 is because we assumed a 25% growth rate. But this 25% growth rate keeps changing depending on things like quarterly earnings reports, market news, mergers and acquisitions, new product launches, or new competitors entering the market. So when these changes happen, you might have originally thought that company A would have a 25% growth rate for the next few years. But looking at recent trends, sometimes it's hard for them to even reach 20%, let alone 25%. Then the stock price drops a lot. When the stock price keeps falling like this, the momentum weakens. So in my case, I tell people to sell their stocks when the price drops. So the meaning of a fair stock price is that changes in fundamentals are reflected in the stock price, and this is shown as a momentum indicator. Buying more of a falling stock just because it seems cheap is risky, that's my point. Ultimately, I think it all connects to this. We look ahead 1 year to determine a fair stock price, and then we do the same for 2 or 3 years out. But after calculating today's fair price, we can't just leave it alone. We have to keep checking if it's still accurate. So, in the true sense, long-term investing really means checking at least every few months. You need to have the attitude of recalculating the fair stock price you had in mind. That's what I want to emphasize.
Yes, Chief Executive Officer Kim, you made a great point. So if I could just add one thing, that was really a great point you made. So as I mentioned once before on the screen, normally the earnings per share growth rate and the stock price increase rate should move together like this. But in reality, the stock price often rises much faster than the earnings per share growth rate. Or it drops much faster. That's how these patterns move. What you're talking about right now, so that's what we call momentum. This thing called momentum, when the growth rate goes up a bit, the stock price should rise by the same amount, but the market doesn't react that way. Momentum is when the market reacts much faster and pushes things up positively. When things decline, the growth rate doesn't vanish. It just falls below expectations, causing the stock price to drop. However, the price doesn't move in a simple way, it fluctuates like this. This happens because it's not machines, but people trading and supply and demand moving, which leads to excessive buying or selling. So in the real market, this is how things move. And if you look here, if it seems like the stock price will go up by 25%, anyone would think they could make a 45% profit. Then people will start buying a lot more. So rather than rising 25% a year, the stock could increase 50% in a year. So we shouldn't overlook these aspects, and I think these are probably connected to the momentum that Chief Executive Officer Lee mentioned. For example, suppose the stock price was $180 and rose to $270 by year's end. But what we're thinking is that this value should be reached in 2027, but by the end of 2025 it already hit $270. Then, after that, the expected return rate will decrease. People who buy here will only get this much return later on. So these people might sell or they might be in a hurry. After hitting the peak, when it starts to come down, they can sell to take some profit and then buy again. This kind of trading is always possible. So instead of labeling it a long-term investment just due to the duration, isn't it more important to make decisions with a long-term perspective? Mr. Chief Executive Officer, your comment reminded me of something, so I added a bit to what I was saying.
Yes, thank you for summarizing it so clearly. All right, then let's move to Choice IQ and show us a real example.
Precious Sim. So, what is the stock I just mentioned? Thank you for watching. So it was NVIDIA. When we did that, the stock price was actually $185, but suddenly it shot up between 5 and 7, and now it's over $207. So if you look here, why do you think the stock price went up? And as we explain, these kinds of features are coming out now, so you can take a look at these things. If you look at the trading signals and valuation, this one, it's in the stage where it's rising from undervalued to overvalued. Even in the previous video, among semiconductors, the stock I picked as my top pick without hesitation was both good and simply cheap. While most companies have already reached overvaluation, this one is now in the stage of breaking through and rising. Now, if I look at the growth rate, I need to put the G in 2G for the future growth rate. When I look at the earnings per share, it's 49%. It's January 2026, so it's nearly over. We shouldn't use 49%. When calculating the PEG, the value changes depending on whether I use 49% or 39%. That's why I mentioned during the Q&A earlier that it's better to look at the PEG depending on the period. So the growth rate is decreasing like 49%, 39%, 20%. Then what growth rate should we use for this company over 3 to 5 years or about 5 years? That's something we really have to think about. So instead of using next year's growth rate, you should look for a period where NVIDIA's growth stabilizes and doesn't fluctuate as much. Using the percentage for that period is what we mean by using this growth rate. It's the same for PEG as well. Templeton also has a method for evaluating growth rates. It's the same with Templeton. When it comes to growth rates, they all look at the long term, but we don't really know much about the long term. Of about 5,500 American companies, around 4,800 have consensus estimates. In Korea, only about 500 out of 2,600 companies do. Korean investors have to work much harder with Korean stocks. That's right, it's difficult, it's much harder. If you're good at making profits in Korean stocks, a small mindset shift shows United States stocks move more rationally and offer more data on large companies. So I think it would be good to try both together. Now let's look at the growth rate here. Since it's dropping, you can't use numbers like 49 later. You'll need to reconsider how much to use for this. But when you look at sites that show earnings per share, growth rates, and other growth-related figures, some of them display up to 5 years at most. For example, on MarketScreen and similar sites, you can sometimes see data for about 4 or 5 years. So if you go there and look at about 5 years of data, you can calculate the average annual growth rate from year 4 to year 5, and using that growth rate is the most reasonable approach. If you're unsure, try this next. Then actually, this growth rate is connected to the return on equity below. The reason why this company's return on equity keeps dropping is because the growth rate, the earnings per share growth rate, is declining. In the past, I talked about return on equity. After we finish this, from next time, we'll be dealing with return on equity. Return on equity is the shadow of the earnings per share growth rate. The stock price follows the shadow of the earnings per share growth rate, and the stock price moves according to the earnings per share growth rate. Return on equity is the shadow that follows the earnings per share growth rate. Comparing earnings per share growth and return on equity, NVIDIA currently has a 39% earnings per share growth rate and 50% return on equity. Since earnings per share growth is lower, return on equity converges to the earnings per share growth rate. Return on equity drops 100% the next year, falling to 44.5%. Then what happens in 2029 is, if you look at 2028, it's 20.2%, and this one is 44%, so the return on equity is higher. In that case, as of January 2029, the return on equity will also drop. Return on equity follows the earnings per share growth rate. But if the earnings per share growth rate is higher than the return on equity increases gradually. It keeps going up. In the end, this return on equity is what Buffett called the sustainable return on equity, which is the same as the long-term growth rate that Graham mentioned to Peter Lynch earlier. So where this return on equity will drop and converge is the number you need to put into that growth rate. This is too hard for an introductory course. It's a pretty difficult topic, but what I want to say is that you can use a growth rate number for about 5 years here. Otherwise, since this return on equity keeps dropping, you need to consider where the return on equity will settle and what percentage the return on equity will be. So, regarding Daeguan Shinji, next time, when I have time, I'll tell you where it's good to estimate it. You can also find that in the financial statements. I'll explain that as well. So for today, regarding the growth rate, You can either use the growth rate provided by sites that offer projections for the next 5 years, or if not, there are companies with similar return on equity. Even though this one is dropping steadily, there are companies with similar return on equity, so you can just use the average of those similar companies. So for numbers like 34, 32, and 30, you can just use the 3-year average as the growth rate. But when you use the growth rate, listen today and move on, use a different growth rate depending on whether a company pays high dividends. If we cover that much today, it might take too long, so I'll talk about that next time. For now, if you're going to use return on equity, if the growth rates are similar, it's okay to use the average. But in the case of NVIDIA, the refill growth rate is lower than the return on equity, so the return on equity will decrease even more. Simply put, you shouldn't use anything higher than 44% here. You need to use a much lower number than this. The reason I set it at 25% earlier is because the lowest growth rate at the very end is 20%. And as I look at the current performance and other factors, I keep seeing a bit of upside. So I just decided to go with about 25%. That's why I arbitrarily chose the number 25%. And as you said earlier, it's not just about calculating it once and being done every time this number changes. Like if it goes up from 20 to 22, then it matches my expectations better. Or if it drops, I need to adjust it lower. You need to rebalance things like this and recalculate them at least once per quarter. For those who are diligent, maybe once a month. But since these numbers don't change much, I think once a month or once a quarter is enough. So I think that kind of follow-up should be sufficient. Personally, I think people who own United States stocks usually have about 5 at the least, or up to about 10 at most. If you have that much interest and look at this, I think you'll find it more useful. Earlier, I wanted to explain the interest rates. This is a website where you can check corporate bond interest rates. You can check it here, Federal Reserve Bank, St. Louis. So it's a site called Federal. You can find the AAA corporate bond yield announced by Moody's here. And if you look, you can see very long-term yields. So the yield I used earlier comes from here, 5.1. I took it from here. They told you to put in the outflow amount. If not, 000, DWalk, Beidol, Minjok will completely hit rock bottom. If you look at this interest rate at this time in the history of the Earth, interest rates were low and accessible. So for those who needed money at that time, wouldn't it have been most advantageous to get as much as possible in fixed rate loans? But now, since the interest rates have gone up, it's up to 5% here, so now discounts must be offered. The reason why Trump keeps insisting on lowering the interest rates is because if you lower the rates, it helps the economy, it helps corporate stock prices, it helps everything. So that's why they're trying to keep pushing the interest rates down. So if you look at this site, I think you can see it for yourselves. If you don't know the address of this site, if you just type something like United States 30-year corporate AAA company minimums on Google, the address for this site will probably come up right away. If you go there, you'll see current interest rates, and you can see whether they're going up or going down. So when interest rates fall, it's good news for the stock market, but if interest rates keep rising, it's a negative for stock prices and company values. So I think it would be good if you pay close attention to these aspects. It was a bit tough, but let me say one last thing. This is also a key part when you study valuation later. Let me explain one thing. Why do bond prices rise when interest rates drop? Usually, you just memorize this for exams. Interest rates and bond prices move in opposite directions. So why do prices go up when interest rates change? I'm going to explain that to you now. Alright, let's say you bought a bond for 10,000 won with a fixed coupon rate of 5%, so you get 500 won in interest every year. Since you bought it, you get 500 won each year. But after a year, the market interest rate fell by 1% to 1%. At this time, the bonds being issued are giving 4% 401, but since I already bought it before, I still have the right to receive 501. They're selling the right to get 401 for 10,000 won now. Now then, how will the price compare to this one? Of course, the price for receiving 501 should go up. It wouldn't make sense if the price for getting 401 and 501 were the same, because this isn't a capital market. So when the interest rate drops, the price goes up because the interest rate I was originally receiving is higher. Yes, it means it goes up. Then the question is, how much will the price of that bond go up? Let's try calculating that, and I think it would be good to use this when investing in stocks or long-term bonds. Now, this is the last slide. So how much will my bond increase? That's the question. Yes, assuming the market is rational, then what this means is that the 501 I'm currently receiving at 4% interest, prices will rise until recent bond issuers also get 4% interest. Then, to calculate that, I'm currently receiving 501, and I just need to divide this by the 4% interest rate. It becomes 12,501, and applying a 4% interest rate to that gives this result. That's 501. Since the interest rate is now the same, I can transfer this to someone who bought it for 12,501. Since the market rate is 4%, I can sell it for 12,501 after buying it for 10,001. Then my return is 25%. The interest rate only changed by 1%, but my return jumped to 25%. That's amazing. When the interest rate drops by 1%, it impacts corporate value this way. I refer to it as a bond, but consider the 501 as earnings per share instead of interest. I receive this much earnings per share every year, but unlike bonds, this is a company where the earnings per share increases every year. But what if you think about the interest rate dropping? Even just receiving the same amount right now, if the interest rate drops, the price goes up by 25%. If a company raising its interest yearly also gets a rate drop, the price rises even faster. That's why growth stocks rise much more when interest rates fall or are lowered. It's exactly because of this reason. When interest rates drop, stock prices are greatly affected. It's a big positive. On the other hand, what happens if interest rates go up? The opposite effect occurs to the same extent. It's a negative factor in these situations. Even when you invest in stocks, you should see lowering interest rates as a very good signal. You can see it without much difficulty. If you're investing in bonds, when interest rates are lowered, you shouldn't buy bonds when interest rates are low, like around 2%. From now on, if I buy bonds at 2.5%, which will never come again, it means interest rates are going up. When interest rates go up, bond prices drop. Of course, if you hold them until maturity, you receive the face value, but there's no profit from the bond price. With a 2.5% coupon, that's your only return. If you're looking to make capital gains from bond prices like you would from stock price increases, buy bonds when interest rates drop. Interest rates become the main focus then. When there are signs that the market isn't doing well and it looks like interest rates need to be lowered, buying bonds is good, especially long-term ones. There are short-term bonds, like 1 year, and long-term, like 30-year bonds. This is due to their differing interest rate sensitivity. The speed at which the price rises is much faster for long-term bonds. So when interest rates go down, that's the trend. So if you buy long-term bonds or ETFs related to long-term bonds, this might help, but I'm not saying to invest in bonds now. Bonds have fixed interest rates. Stocks have earnings per share that can fluctuate, but we're betting on it going up. When interest rates fall, it affects stock prices on the upside. If you understand this concept, it will be very helpful conceptually when you value stocks later on. That's all for today's content.
Since bonds came up, let me give you a brief explanation. There were actually some people who got stuck with bonds. It was before the Trump administration came in. So the Fed started lowering interest rates. A lot of people bought bonds at that time. Korean investors did too. Because theoretically, since interest rate cuts had just started, if rate cuts have begun, naturally they thought bond prices would go up. There were a lot of people who invested in bonds. But what's important here is that the interest rate we're talking about is the base rate. But the bond interest rate we're discussing is the market rate. Although the base rate has fallen, the bond interest rate is still decent at about 4.6%. So there are still a lot of people stuck with bonds because the rates haven't gone up at all. The reason is that even though the base rate dropped, the market interest rate didn't budge. That means United States Treasury bonds aren't very popular right now. When President Trump came in, there was a lot of talk about tariffs. The dollar fell and similar events occurred. People started saying that the United States economy was shaking and that America's era was over. United States Treasury bonds are less popular now, so the situation remains unchanged. If later on Trump's policies actually prove effective and the United States economy gets much better, then even if the base interest rate doesn't go down, bond yields could actually fall. So for those of you who might be stuck right now, if the United States economy improves later, bond yields could fall and bond prices could go up. So since you've already held on this long, it might be good to hang in there a bit longer. That's something I think about as well. These days, I'm also keeping an eye on Ethereum with interest. There's now a cryptocurrency tied to bonds. Now, once stablecoins start being used in earnest, like in South America, where it already seems they're being used a lot all over the world, if stablecoins actually start being widely used for payments, depending on the speed at which these stablecoins are issued, the dollars linked to them have to be purchased. And eventually, that money inevitably flows into bonds. If that happens, the demand for bonds will rise and eventually bond yields could fall. That's what I personally think. I'm not investing in bonds right now, but for those of you watching who have been stuck with bonds for over a year, I hope you'll keep in mind that there's this kind of hope. Today, the level at Migok Elementary School was a bit too high. Thank you for covering a variety of different areas. Should we change the title to American Knowledge High School?
Middle school.
High school. Actually,
Since we've been building from the basics, I think we have to keep progressing gradually like this. So if you don't have the basics at first, honestly, if you just listen, I think it will get harder and harder for those listening to this broadcast. For those who started from the basics, it's enough if you can just get a sense of what we're talking about. You probably won't be able to understand everything we're saying all at once. Even after several listens, it sounds easy to me since I'm explaining what I've already studied and understood. For those hearing this for the first time, I think I wouldn't understand what I'm saying either. Please don't lose heart, and I would appreciate it if you could stay with us until the end so we can make it to elementary school together.
Since we have a good teacher, I believe many of you are able to follow along without any trouble. Well, today as well, we listened to a very valuable and excellent lecture. We'll be able to record at the same time next week as well, right? Yes, that's good. Then I'll greet you again in a week. And if I happen to have a day off in between, it would be great if the Chief Executive Officer could also cover for me.
Yes, I understand.
Then thank you for your hard work late into the night, and I'll see you again next week. Yes.
Thank you, yes.
Thank you.
The beginning of any dream is important. Let go of your greed, grow little by little every day, and enjoy today's journey. Even if tough times come, I'm not afraid. Retiring with American stocks.